Welcome to the part 2 of the standard costing and variance analysis. In here, we're going to talk about direct labor variances and the overhead variances, including the variable and the fixed overhead. So, I've already discussed on the part 1 of the video lecture the raw material variances, the price, the quantity, the yield, and the mix variance. So if you wanted to know, you wanted to master standard costing topic, I suggest you need to start watching first the part 1 of standard costing lecture video that I made. Now, if you're new to my channel, please click subscribe and hit the notification bell so that you'll be first on the next uploads that I'm going to make. So with that, let's start the part 2. So let's start with the illustrative problem. By the way, this illustrative problem has been the same with the illustrative problem with the video lecture number 1 on standard costing. Let's go through it again. ABC company forecasted in 2019 that in the year 2020, the company will make 1.2 million anti-COVID tablets or 100,000 tablets monthly. So the details from the master budget and production requirements are as follows. In terms of raw materials, a tablet, a 350 milligram tablet, is composed of 150 milligrams of chemical A and 225 milligrams of chemical B. Now, each milligram of chemical A costs 1 centavo and each mg of chemical B costs 0.75 centavos. The direct labor, a single tablet can be manufactured in 40 seconds and the workers are paid on the average 50 pesos per hour. As to the variable overheads are computed to be 65 pesos per hour. On the fixed overhead, on the plan, the overhead is 900,000 annually or 75,000 monthly. So the actual data for the month of January consists of the following information. The actual output is 97,000 tablets as compared with the plan, which is 100,000 tablets. And the chemical A used is 14,700,000 milligrams for 149,940. And the chemical B is 19,600,000 milligrams is used for a total cost of 145,000. The direct labor used is 1,100 hours for a total cost incurred of 56,100. The variable overhead is 71,368 and the fixed overhead is 73,000. So our job on the video lecture number 1 as well as in this video is to prepare standard cost and variance analysis. However, the raw materials again have already been discussed on the video lecture number 1, so we're not gonna need the details for the raw materials. So we need to focus on this. However, there is a simplification of the given and instruction for you to be able to see what are the necessary items to be considered when computing. So this is the simplification and the analysis of the given. Let's start with the direct labor. The direct labor, according to the plan, is one product is produced per 40 seconds and each hour of labor of a certain worker costs 50 pesos. On the actual, the direct labor hours used by the company is 1,100 hours and the total direct labor cost incurred is 56,100. That's the simplified version of the illustrative problem. Let's go to the variable overhead. On the variable overhead, as per plan, 1 hour costs 65 pesos, but in the actual, the variable overhead cost, we have 71,368 pesos. On the fixed overhead, if we take a look at the plan says we're gonna incur annually 900,000 divided by 12. We're gonna get the monthly of 75,000. And in the actual, the fixed overhead cost incurred is only 73,000. So the actual output for January versus the plan, let's start with the plan. The plan number of units for the month of January is supposed to be 100,000, but on the actual, the company has only produced 97,000. So that's it for the given. So let's compute for the standard costing and variance analysis for direct labor. But first, we need to know that the plan is always different from the actual. And when comparing the plan from the actual, when it comes to direct labor, let's say for example, the actual direct labor cost is greater than what was expected or what is in the standard. So what are the reasons behind it? One might be the rate variance. What is this rate variance? This is when the actual rate for the employees that was paid is different from what is expected or what's in the plan. There may be a lot of reasons. Let's say, for example, there is an increase in the minimum wage, or for example, there's a sudden salary hike of the employees because it's in their collective bargaining agreement or the agreement between the employees and the employers. So that's rate variance. So aside from rate variance, we have what do we call the efficiency variance, in which you're just going to compare the efficiency of the workers based on the actual and based on the plan. So in order for it to become clearer, let's go to the example. According to the illustrative problem, according to the plan, one product should be produced in 40 seconds. Let's say, for example, in the actual, one product has been produced in a minute. So it means that there is an efficiency variance. The workers have not been efficient. And normally, the answer for the efficiency variance in here is unfavorable. So that's efficiency variance. So before we compute for the rate variance and the efficiency variance, we need to know what are the things that we need to compare, and that is the actual direct labor cost and the standard direct labor cost. So let's first start with the actual direct labor cost. To get that, we need to multiply actual hours with the actual rate, and then we're gonna get the total cost. According to the problem, the actual hours is 1,100 hours. And the total cost that was incurred is 56,100. And in order to arrive with the actual rate, we need to divide 56,100 by 1,100, and that is 51 pesos. Now let's go to the standard cost. So we have standard hours times standard rate, which is given already in the problem, 50 pesos per hour. That's according to the plan. The standard hours is 1077.77. We are going to compute this later. How did we arrive with 1077? I will discuss later. But for the meantime, if you're going to multiply 1077.77 times 50, then you're gonna get 53,888.89. And as you can see, there is a variance or a difference. So how much of that difference is considered as rate variance and how much of that difference is considered as efficiency variance, we will know later. So let's first start computing for how did we get the 1077.77. So since I've already told you that the standard and the actual is always basing with the actual output, then standard hours computation starts with the actual output of 97,000 tablets, and this actual output will be subjected to the plan. So if 97,000 tablets actual output is subjected to the plan, then the process time is 40 seconds per tablet. And then, if you multiply them, you're gonna get a total 3,880,000 seconds. To convert that into minutes, you need to divide it by 60. So, in minutes, that is 64,666.66 minutes. And in order to convert that in hours, you need to divide it again by another 60. And that's how you get the 1077.77 hours. So, let's answer the question, how do we get the rate variance? So, we can get the rate variance if we compare this 56,100 with another amount. And that amount is actual hours times standard rate. So, on the actual hours, it's still 1,100 and then the standard rate is at 50. So, the total is 55,000. So, the difference is what do we call as rate variance, which is 1,100 unfavorable because on the actual, 56,100 was incurred, versus if ever we use the plan, we're just going to incur 55,000. So there is 1,100 unfavorable rate variance. Notice this, the actual hours in both the amounts is the same, because we are only concerned with the difference in rate. But on the rate, they are not the same. So the actual rate incurred is 51. It is expected to be only 50. So there is really a difference, or what do we call as rate variance. It's more expensive in the actual. So that's how you get the rate variance. How about efficiency variance? It's easy. You just need to deduct the second amount, which is 55,000 minus 53,888.89, and you're gonna get an unfavorable amount of 1,111.11. As you can see, the rate is the same, because we're not interested with the difference in the rate here. We are interested in the question, are the workers efficient? So as you can see, in the actual, they have used 1,100 hours in order to produce the 97,000 tablets. But if we're going to follow the plan, they should have only used 1,077.77. So they are inefficient. That's why the answer is unfavorable. And lastly, I would like to tell you that mix and yield variances is also applicable on the direct labor only if there are two types of direct labor that is involved in the production. Like in the materials, if there are two types of materials involved in the production, mix and yield variances apply in here also. The only difference is that instead of using price, you're gonna use rate in here. And of course, instead of using quantity, you're going to use actual hours or standard hours in here. So that's it for the direct labor. Let's move now to the variable overhead. On the variable overhead, it follows the same pattern as direct labor and direct materials that I told you in the first video. That is what do we call as the AAS. So actual hours times actual rate equals the total cost. According to the problem, the actual hours is 1,100 and the total cost for variable overhead is 71,368. So let's derive the actual variable rate. This is not the same with the actual rate in the direct labor. This is what we call as actual variable overhead rate. So we're gonna get 65.125. So that's the actual variable overhead cost. Now, the next is 1,100 actual hours times standard rate. The same pattern. The standard rate is 65 pesos. So the total is 71,500. So the first and the second, you're going to deduct, and the difference is 138 pesos unfavorable because the actual variable overhead is greater than what is expected, which is 71,500. What do we call that? If in the materials, the first and the second results to price variance, and in the direct labor, the first and the second results in the rate variance, in here, it results to what do we call as spending variance. So it's like they are peso symbols: price, rate, and spending. And the last is standard hours, which has already been computed here. It's 1077.77 times the standard rate of 65 equals 70,055.55, and you need to deduct it from 71,500 in order to get another 1,444.45, which is still unfavorable, and that is what do we call as efficiency variance. However, there is a unique part in here in the variable overhead, because the first and the second amounts, so 71,638 and 70,055.55, if you're going to deduct it from each other, you're gonna arrive at positive 1582.45 unfavorable, and that is what we call as controllable. So there are three variances involved in the variable overhead. So that's it for the variable overhead. Let's go now to the fixed overhead. So on the fixed overhead, the pattern AAS is still relevant. AAS, by that I mean actual hours, and standard hours. The same with the pattern and the variable overhead and the direct labor. So let's complete. You have actual hours times actual rate, actual hours times standard rate, and standard hours times standard rate. So basically they are the same with the direct labor and variable overhead. The only difference is that in the fixed overhead, there is one that we're going to insert. That is the budgeted hours times standard rate or budgeted rate, because they are the same. So let's supply some numbers. So the actual hours is 1,100. The actual rate is 66.36. And the total cost is 73,000. Actually, the 66.36 has not been given. It has been derived by means of dividing 1,100 from the 73,000. So we have 66.36. We have the budgeted fixed overhead rate, which is 75,000. It is given. The fixed overhead annually is 900,000 and monthly it's 75,000. So that's where we got the 75,000. The only problem is we don't have the budgeted hours and the standard rate, so we need to derive it. So the budgeted hours is 1111.11. Still, it's not found on the given. We need to compute it. So how do we compute the budgeted hours? Unlike the standard hours, which is based on the actual output, the budgeted hours is always based on the planned output or planned production. So the planned output, as per the given, is 100,000 tablets. And then, according to the plan also, one tablet can be processed in 40 seconds. So you multiply that, you're gonna have 4 million seconds. And to convert it into minutes, divided by 60, you have 66,666.66 minutes. And to convert it into hours, divided by 60 again, we have 1,111.11. That's how we got the budgeted hours. So basically, it means that if we are to produce 100,000 tablets and we're going to go with the plan, then we're going to consume 1,111.11 hours. So that's it. So how do we get the standard rate? So based on the 75,000 divided by 1,111.11, we're gonna get the standard rate. The standard rate is 67.50. And then we have 1,100 in here times 67.50. This is just copied from here, and then we're gonna have 74,250, and the standard hours is 1077.77 as computed here, times 67.5. We have 72,750. That's why I told you there are two general formulas that is being used in this video lectures. For the variables, I'm using the AAS, direct materials, direct labor, and variable overhead. But on the fixed overhead, I'm already using the ABAS. So there are two general formulas, AAS and ABAS, except for mix and yield. So since we have already completed the ABAS, first and second number, 73,000 minus 75,000, is negative 2,000 or favorable. What do we call this one? This is what do we call as spending or controllable variance in the fixed overhead. So sa variable overhead, the spending and the controllable is not the same. Here in the fixed overhead, the spending and the controllable variance is the same. The second and the third, 75,000 minus 74,250. is what do we call the idle capacity variance. So that's 750 unfavorable. And the third and the fourth is what do we call as efficiency variance. And the efficiency variance for the fixed overhead is 1,500 unfavorable. But there is still one type of variance left. The second, the 75,000 minus the 72,750 is 2,250 unfavorable. That is what do we call as volume variance, or what others call uncontrollable variance. So that's it for the fixed overhead. So in order to complete your knowledge, let's say for example, you need to compute for the total spending variance. So that's just the spending variance here in the variable overhead plus the spending variance here in the fixed overhead. So this is just actual hours on the variable times the actual variable rate minus the actual hours times standard variable rate that's on the variable. And on the fixed portion, you have actual hours times actual fixed factory overhead rate minus budgeted hours times standard fixed factory overhead rate. So that's how we do it on the AAS and the ABAS of variable overhead and fixed overhead. But you know what? If you are going to add this actual hours times actual variable rate plus actual hours times actual fixed factory overhead rate, then you are going to get what do we call as AFO, or actual factory overhead. This is the variable portion plus the fixed portion. That's the total actual factory overhead. And this two, the actual hours times standard variable rate times budgeted plus budgeted hours times standard fixed rate is what do we call as the BAA, or budgeted based on actual hours. So that's BAA and some other authors. That's why in order to get the total spending variance, aside from adding the spending in the variable overhead as well as in the fixed overhead, there is an alternative formula known as AFO minus BAA. Another is when you are asked to compute for the total controllable variance, on the variable, we have actual hours times actual variable rate, this one, minus standard hours times standard variable rate. On the fixed, since spending and controllable are the same on the fixed overhead, so they are similar. Actual hours times actual fixed rate, and then budgeted hours times standard fixed rate. So where do they differ? Only in this element. Here we have actual hours, here we have standard hours. So again, when you're going to add the variable portion plus the fixed portion, you're gonna get the actual factory overhead. And if you are going to add the standard hours times standard variable rate plus budgeted hours times standard fixed rate, you have what do we call as BASH. Again, that SH and AH is this one and this one. So that's how you get the controllable variance. The alternative formula is AFO minus BASH. So that's the end of the part 2. But before we end, let me clarify that these formulas, first, is very uncomplicated. This is not complicated. You just have two general formulas, except for the mix and yield, of course. We have AAS for the variables, and of course the ABAS for the fixed overhead. Second, it's easy to get answers in here even if the problems are not straightforward just like this. What do you mean, sir? For example, if efficiency variance 1.5 is given and 72,750 is also given and this is not given, then you can actually work it back by means of adding 1,5 plus 72,750. Just like that, you'll be able to get the 74's 250. And if you're gonna get this, for example, and this 67.50 is absent but the 1 is given, you can also work it back. So no need to make complicated algebraic equations in order to use the AAS and the ABAS. Aside from that, the AAS and the ABAS does not care when it comes to overhead about the one-way, two-way, three-way, four-way, five-way. It's just answers all the requirements on a certain problem. So that's it for standard costing. Please visit the standard costing lecture video number 1 in order to master the topic. And if you wanted to, just play and replay in order to master the topic. So thank you.